What? G'day. Apparently, it sounded like I was sucking helium before. Which I'm sorry about. And I hope you're still there and you haven't gone away, because we had to cut it off and start again. We had to restart the phone. Yes, I'm sorry about that little interruption. But we can't have me sounding like a jockey or whatever. Not that there's anything wrong with sounding like a jockey, except that it sounded pretty funny. All right, okay, well, let's get stuck into it. I was raving on about Christmas trees before we were so rudely interrupted. The trouble with technology, there are always new ways to stuff up, which is what I'm finding at the ABC at the moment, by the way. They've just introduced a whole new tech system, software, a whole new software system at the ABC, which is driving me crazy because it never works. And it's far worse than the one before. It's unbelievable. You would have thought that, if you're going to spend millions of dollars on a new software system, it'd be better than the last one, but apparently that's not the way it works. Anyway, let's get stuck straight into the questions. James says, what are your thoughts about buying a company around AGM time? Should you wait until after the AGM? Well, James, I'm not sure the AGM is of much relevance to the price, except if they, as they sometimes do, come out with a profit update, which is the first quarter, and it's negative or positive. So not all companies do that. Some do, some don't. Sometimes it's good, sometimes it's bad. So it's very difficult to anticipate that one way or the other. I wouldn't really take much notice of the AGM. The thing to take notice of, which does happen around about the time of the AGM, is the ex-dividend date. And the question, of course, is whether you want the dividend or whether you don't. And if you want the dividend, a lot of people buy just before the stock goes ex-dividend, so that they get the dividend and then they sell out later. I'm not sure why people want to do that. Someone's coming back in. Apparently it's working okay this time, but we're adjusting it. James is fiddling with it, which is putting me off, and now we're okay. Apparently I'm straight now. That's good. It's really a matter of the dividend, I think, James, rather than the AGM. And the question is whether you want to buy a company before the dividend to get the dividend and then to sell out later or not. That's kind of, a lot of people do that. Not entirely sure why, but that's just because they're focused on the dividend, obviously, and want their capital out again. But obviously, the price comes, the dividend comes out of the price. So you've sold. Perhaps there's a tax advantage in that. Chris says, do you think it's worth selling Mantra, MTR, now for about $3.90, or waiting until the takeover offer by Accor Hotels Group takes place in about March 2018? Do you think there will be a higher offer? They seem to have stabilised at about $3.90. Yes, I don't think there will be a higher offer. The offer, of course, Chris, as you know, is $3.96. So what's going on now is that hedge funds who just used a simple arbitrage on the time value of money are buying now to make the 6 cents in 3 months, and for them that's worthwhile. It's like picking up chips at the beach for seagulls. They're making a little bit on it, and there's quite a bit of turnover. A lot of people are selling now to get their cash, and they're happy to give that 6 cents to the hedge funds that are doing it. Really, I certainly don't think, unless you're one of those hedge funds, there's much point buying now. I mean, the reason it works for the hedge funds is because they do huge volumes. They'll buy millions and millions of shares, and for them it's worthwhile. So unless you're in that game of spending $10 million on shares so that you can make that that small percentage profit, there's not much point buying now. And if I was a Mantra shareholder, I would definitely sell now. Get my $3.90 and go and put it in something else, because the gain between now and March is not that much, and $3.90 is fine. So really, it's a straight out mathematical calculation. What's the percentage? I haven't actually worked it out. The 6%, 6 cents is a percentage of $3.90, and do you want to make that 6 cents between now and March or not? Leon says, "Hi Alan, just waiting to see the result of your follow-up queries regarding Fortescue. After the slight put down by another industry player, you became a little less sure of your recommendation. Could you please let us know the outcome of your inquiries?" Okay, so I was talking about Fortescue as a yield investment and also saying that I like the way the company's run. I think it's very well run. The stock is still yielding more than 9%. At the time I wrote about it, it was 10%. It's come back a little bit, but it's still yielding 9% plus fully franked. And it was, at the time I wrote about it, it was the highest yielding stock, fully franked stock particularly, in the ASX 200. And I think I'm pretty sure it still is. So I was looking at it as an income stock, and I'm still think that it's it's a fantastic investment for income. Now, like any high yielding investment, anything that's yielding 9 or 10% net, grossed up more than 10%, is not without risk. Obviously, that is a high yield, and there are risks. Now, there are two risks with Fortescue. One is the fact that Nev Power, the CEO, is moving on, and so there's a management risk. Nev Power is the force behind Fortescue. He's the guy who has got their costs per tonne of iron ore down from $40+ US per tonne to about $12 per tonne. A phenomenal performance, really one of the great mining efforts that I've ever seen that Fortescue and Nev Power pulled off. But look, it's not just about one man, one person. It's a good culture. Andrew Forrest, who's the controlling shareholder and the chairman, is a good guy. I think that his heart's in the right place, and he knows how to create a good culture. I'm pretty sure, I think we can all have confidence that Nev's successor will do a good job as well. The second risk concerns the quality of their iron ore, which is the lowest. That's the problem, and that was the thing that the other industry player was on about, saying that that's a considerable risk in his view and will cause problems for Fortescue down the track. Really, the thing is, you've got to focus on the realised price that Fortescue gets, which is about $45 US per tonne instead of the 65 or so that it is at the higher quality levels. So look, Fortescue gets a lower price. It's built its company around that. In my view, it's it's a reasonable bet. It's not, it's a reasonable risk to take, but it's not zero risk. The question, I guess, is if you're buying it as an income investment, the question is, can the dividend be maintained? Will they maintain the dividend? And the figure that I kind of take some comfort from in that regard is their payout ratio, which is about 52%. Is that right? It was so the free, yeah, that's right. So the free cash flow was over $3 billion. That's free cash flow after capital expenditure was over $3 billion, and the dividend was 1.4 or so. So they're only paying about half the free cash flow out in dividend, and I do believe that there's plenty of room for them to maintain the dividend, if not increase it. So last year it was 45 cents per share. I reckon there's no reason why you can't expect 50 cents next year. So I believe that the dividend is maintainable despite the risks, and because they've got a fair bit of buffer in their cash flow, and I think it's a reasonable bet on the Chinese construction market. There you go. So yes, I did become, when I saw that stuff from the other industry player, I became a little less sure. I am saying that there's no 100% in this game. Fortescue is not 100%. It's not risk-free. However, 9 to 10% yield looks pretty safe to me, and it is not, as I say, but it's not without risk. Jerry says, how do you expect Domain to perform on the ASX? Because because Jerry was asking me, what do I think of Domain? And I said, well, I'm interviewing Anthony Catalano, the CEO, on Friday, which I did last Friday, and we published the interview. And Jerry came back and said, well, yes, but I want to know what you think of the business. And well, I'm slightly conflicted in that my son Chris works there as a journalist, and it's his birthday today, by the way. Turns 29. So happy birthday, Chris. I don't think he's watching, but anyway. So he works there. Just so you know, that's by way of declaration. What do I think of it as a business? I think it's really well run. Catalano is a high quality CEO, very smart guy. I've known him for, I don't know, 20 years. I gave him his first job, in fact, at The Age, as I revealed in the interview. Made him property editor at The Age. He went on from there. So look, I think the management's good. They are a profitable number 2 to REA, and their strategy involves upselling. So there's two levels of profitability for the business. One is simply selling listings, and to that extent, it's about volume. And at the moment, volume of listings is down, which is why, say, John McGrath Real Estate's in trouble, because even though prices are up, and there's been a boom in the housing market in Australia, as we know, with prices rising, that's been accompanied by a decline in the number of listings. And businesses like REA and Domain and John McGrath, all real estate businesses, don't make their money out of prices so much as the number of listings. So if it's correct that listings are bottoming now and are likely to rise, then that will produce a sort of a natural tailwind for the revenues of businesses like Domain and REA. But the other thing they're doing is upselling the agents to higher value ads, and that's really the whole strategy that he explained. So it's worth going through the interview with Catalano just to hear that explained. It's all about selling premium listings, which is not so much dependent on the volume of listings in total. It's to do with how many of their listings they're able to sell to premium ads, and that's a sales effort. And to the extent that that's working, so he reckons that for those reasons, their revenue is heading higher, and I have no reason to doubt that. So, yeah, look, it looks like a reasonable, solid investment to me. I mean, I'm not, as I say, I haven't done all the work on it. I'm not an analyst to that extent, so I'm not sort of putting a buy recommendation on Domain for some reason. You know, in some way, I'm certainly not doing that, but But look, both REA and Domain are great companies. As to choosing between the two of them, I suppose I generally would invest in the challenger in these situations. But you know, on the other hand, REA has the strength. I've booked the CEO of REA for an interview. I can't remember quite when that is. It's Tracy Fellows, and I actually had her down for an interview last week, but she pulled out. So I think we're rescheduling that for next week. So we'll pretty soon be able to compare the two of them, Tracy Fellows and Anthony Catalano, and make a decision between the two of them in that way. Mike says, you mentioned in last Saturday's overview that investing for income through bonds is a mistake. Sorry to say, I don't agree. I have an SMSF and is 50% invested in bonds, including indexed, fixed and floating, generally of up to 5 years duration. It might surprise you to know that most Australian businesses issue bonds for finance at very attractive rates. I have some Ostwide and MyState Bank's bonds, which when issued were yielding almost 7% and still yield 5+%. Non-bank bonds are available at rates up to 15% in various currencies. They are not listed on the ASX but purchased through a fixed interest broker, FIG, FIIG, and are easily bought and sold. I wouldn't hesitate to recommend a portion. Good on you, Mike. Thank you for that. And that's good. I suppose what I said about bonds in the overview was that I don't like bonds at the moment. I have owned bonds myself through FIG at various times. I do think that, and I've done very well out of them. I think that they're fine, and I do know that a lot of companies issue bonds to raise money, and it's great, no problem. And as you say, there are good yields. 15% is getting high. I mean, if you're buying a bond that's yielding 15%, well, as I said before, in relation to Fortescue's 10%, 9 or 10% yield, you know, if you're getting that kind of yield, there's risk. It just goes without saying. Never mind, as long as you understand the risks, that's fine. But I do think that there are some really important things to say about bonds. One, firstly, is my mate Stephen Bartholomew has had a piece in The Australian this morning talking about how the bond market, bonds in general, bond yields, are low enough to be forecasting a recession. So what he reckons the bond market is doing at the moment is saying that there's going to be a recession. And that's the point. When bond yields are low, or low-ish, then I'm talking about government bonds here, then that indicates that the bond market thinks that the economy is stuffed. Now, I don't think that. I think that, as I pointed out in the piece in the overview, I think the economy is not, either in America or here, is not going into recession. And if the bond market is predicting that, then it's wrong. But actually, I think more likely the bond market is predicting low inflation but with growth. That is to say, low inflationary growth. And the reason we've got low inflation growth is because of technology. And that's kind of what I was talking about in that overview and previous ones. It's a theme that I've been on about for a while now, is that inflation is down because, in my view, because technology is just building on itself. You know, we've got robotics, which has been going on for a while, automation, now we've got artificial intelligence. All those things are pressing down on costs and pressing down on prices, along with competition. So what we're having now, and will continue to have for quite a while, is relatively strong growth, not booming growth, but growth with low inflation. I think that's fantastically positive for the stock market and for bonds. I mean, bonds, it means that bonds aren't going to crash at some point, because they do. That's what happens when inflation comes about. If there's inflation coming about as a result of growth, bonds go down in price. That isn't necessarily going to happen. So I think it may be, you're right, Mike, that bonds are okay, and you know, that they don't come down in price. That is to say, yields rise because inflation's not going to rise. I mean, that's a big call. A lot of people think inflation is going to rise now that there's growth coming into the market. Employment is falling. That's kind of the debate. And if you thought that inflation was going to rise, then you really would not buy bonds, whether it's corporate bonds or any other sort. I mean, this is definitely a time to be thinking about bonds as holding to maturity. If you buy a bond which pays a particular coupon and you hold it to maturity, that's what I was explaining last week in this session and in the overview. You hold it to maturity, you get that interest rate. And the question of what the capital return does, or the capital value of the bond does, is irrelevant to you, and that's fine. I think that buying some bonds in your SMSF for income, holding them to maturity, whatever it is, 5 years, no problem. I think it's a very fine strategy, and it's a great way to diversify your income away from volatile equities, because with bonds, it's binary. The company either, if the company stays afloat, it pays back the full value of the bond. It isn't a question of whether the price goes up and down as it is with the shares. So, for example, if you bought Fortescue mining bonds, then you know what you're going to get. There isn't a question of them cutting the interest rate or the dividend on it, or you getting copping a fall in the price of the shares. You just get the interest rate. And so I've absolutely no problem with your strategy, Mike. I think it's fine. I just don't think. I think that now with growth coming into the world economy and the Australian economy, that bond prices are more likely to fall than rise. That's all I'm saying. Alan, one for your weekly chat. You've kept us well informed on Bitcoin developments and the Hokusai-type tsunami wave emerging in an increasing number of charts. Is the volume of Bitcoins being traded now at a level that any substantial correction would have a knock-on effect to the real economy? Good question. Now, I guess this question's from Alan. So, from Alan to Alan. The reason that bubbles crashing, popping, affect the real economy is when a lot of people borrow money to buy the asset concerned and therefore go underwater when the thing falls in price. So that particularly happens with property, real estate, and particularly housing. And so if you look back in history, most of the recessions have been caused by housing price falls. Not necessarily from bubbles, but still housing price falls. Everyone is heavily geared into property, into real estate, 80% loan-to-value ratios generally. So therefore, when the price falls, everyone's suddenly in trouble, and you start to get bad debts in banks, defaults, bankruptcies, and leading to unemployment. And that's what happens. You see that sometimes with shares, but really, I think I've been through this before. The 1987 share crash, which was a bubble, did not result in a recession. The recession resulted from a fall in the property market in 88, 89, in turn caused by the increase in interest rates at that time. So that was the last recession we had. There was a recession in the US that occurred after the stock market crash of early 2000, when the dot-com bubble crashed. Again, that was caused by everyone having borrowed money to buy internet shares. So it really has to do with debt. The question, which I don't know the answer to, is to what extent have Bitcoin investors borrowed the money? And I actually suspect it's not very much. I think that most of the investment in the Bitcoins is not borrowed, but I might be wrong. We have absolutely no data on that. So if it isn't borrowed money, then the Bitcoin crash won't have hardly any effect on the economy at all. So we can only hope that people aren't borrowing money to buy Bitcoins and they crash. As long as they borrow money and buy Bitcoins at $8,000 US or 10,000 Australian and the thing goes up, then everyone's happy. I don't know whether it's going to. But the volume of Bitcoin trading is not necessarily an indicator of how much knock-on effect. It's really, as I say, it's really about the debt. Sandra says, read with interest the transcript of the interview with Rare Infrastructure Fund Manager Richard Elmsley, and I'm wondering how he gets to his return figures for the unhedged value fund. He quotes 9 to 13%, yet it lost nearly 10% capital value between May and June 2016 and has not recovered. Taking distributions into account, getting near returns, he quotes only what happens if you ignore the capital loss. Given it's an unhedged fund, what do you think its outlook would be moving forward? I'm thinking the sinking dollar would be a downtrend for them. I'm thinking there are other infrastructure funds that may be worth comparing. Any suggestions? That 10% loss of capital was simply someone taking their money out of the fund. So it wasn't actually a capital loss caused by an investment loss. It was simply that the size of the fund reduced by 10% because somebody took out $100 million. And apparently that much money's flowed back into the fund since then. So it's actually back to where it was. And it really had nothing to do with returns. So the returns are the returns, 9 to 13% in the unhedged fund. As I think you know from reading the transcript, Sandra, there are two funds. There's a hedged fund and an unhedged fund. My view is that if you're going to invest in global infrastructure, you're much better off doing it hedged, not unhedged. I think the only people who should, or in fact do, invest in the unhedged infrastructure are big super funds that have got their own hedging. They've generally got, above their portfolio managers, they've generally got hedging processes in place where they hedge their own exposure. So really, I don't think it's a good idea. If you want to invest in infrastructure, you should do that. I think you should do it hedged so that you're only exposed to the infrastructure and not to currency. Because you're right, if the dollar falls, then you're out of, you're losing money. And the trouble is it's impossible to predict the currencies. And if you reckon if you think you can predict currencies, then invest in that. You can buy and sell FX, and you'll make a lot more money trading FX, foreign exchange. But in fact, it's a very good idea to invest in infrastructure, particularly global infrastructure, and rare infrastructure has got airports and toll roads in Europe and America and all over the place. So it's a good fund. I don't think there's anything wrong with it. They're making good returns, and I think it's a good way to get exposure to global infrastructure. Fair enough. Sandra, we will look at other infrastructure funds. It won't be the only one we look at, of course, and we'll try to provide you with a good menu of infrastructure funds to think about. But the return that Rare, just to finalise that, the return that Rare is quoting is a true return. It isn't affected by that decline in the size of the fund due to someone withdrawing their money. Subrata says, Alan, do you know much about PDN, Paladin Energy? Will they be trading again? No, I don't know. I used to know a fair bit about them. Well, I interviewed the guy who ran it a few times. They're a uranium business, and I don't know whether they'll be trading again. No idea. I'll check it out though and report back. Barry says, some of your recent solid performers over the last 3 months. Market definitely on a momentum charge. Not sure you have interviewed these CEOs, and he's given me a list here which I won't go through. But I have interviewed some of them, but not all of them, Barry. But happy to, I've got a long list of CEOs to interview. I'm only getting through one a day, so that's 200, 250 a year. So I'll get through the ASX list in about 10 years' time, assuming I don't do anyone twice, which I probably will because they need to be kept up with. So we'll have to start doing 2 a day. Subrata says, again, another question from Subrata. What's your current buy, hold, sell view on Vita Group? I'm sorry to say, Subrata, I don't have one. I haven't spoken to them, Maxine Horn, for a while now, so I don't really know where they're up to. They had a bit of a horror show last year with losing some of the Telstra stores, and to be honest, I just simply haven't looked at them for a while. So on the list they go for us to catch up with them. I don't even know whether Maxine's still running the place. I assume she is, but I just don't know. Genevieve. G'day, Genevieve. I wonder if you have a view on pharma stocks like API and Main Pharma. They seem to be tanking lately, but have reasonable dividends. Can you give some background on why the share prices are dropping? So this is the first I've seen of this question, Genevieve, and I really don't want to give you an answer off the top of my head. So let me have a look at that and see if I can either answer it next week or perhaps in the overview. Andrew says, I'd love to hear your thoughts regarding the OTC Act signed by Trump. What is that? What's the OTC Act? I should probably know this, Andrew. Let me have a look. OTC Act. What is it? Conversion to Public Company Act, 1988. Really? Don't know. I don't know, Andrew. Sorry. Is someone going to tell me? Yeah, over the counter what? Signed by Trump. This I feel has opened a huge market in wearables. Any companies you recommend would capitalise on this new market opening? I have invested in NUH, New Hera IQ Buds. Over the counter act, signed by Trump. Got me there, Andrew. Sorry. I'm none the wiser on that. Sorry. I'll have to. That's another one on my list of things to look up. These questions, the last couple of questions, I haven't had a chance to look at before this session, but I will, and put it into. I think I'll probably put that one into the overview, Andrew. So thank you for that question, and thanks for being with me today. It's been great, and it's time for me to head off to see JK at the cafe and do the Money Cafe. So great to see you. Thanks for joining me. See you next week.